Think for a moment about the fact that you have been paying your insurance premium on time for 10 years, every single month. Without fail, you have set aside a portion of your budget in dollars to buy peace of mind. Then one day, the unexpected happens. A kitchen fire, a flood from a burst pipe, or a health crisis that requires urgent surgery. You call the insurance company with the confidence of someone who has a signed contract. But on the other end of the line, a kind but firm voice tells you that they are sorry, but your case falls under the exclusion for lack of preventive maintenance or normal wear. And in that second, 10 years of payments evaporate, and you are left alone with a debt of thousands of dollars. This is not an isolated case. It is the reality of how the clauses that no one reads actually work. Today, we are going to analyze these universal exclusions so you can understand why the insurance you think you have might actually be a worthless piece of paper when it matters most, especially when we talk about protecting family wealth in 2026. Reality of the insurance industry in the United States, Europe, and Latin America is that the business is not about paying claims, but about evaluating risks in a way that the company always maintains its profitability. Companies are experts at drafting contracts where coverage looks broad in the advertising but shrinks drastically in the fine print. If you are over 40 years old, you know that money is not a gift and that financial institutions always seek to protect their own balance sheets. For that reason, today we are not going to give legal advice. Instead, we are going to educate ourselves on the anatomy of these contracts so you stop being victims of your own ignorance. Stay with me until the end, because we are going to break down the 5 traps that could leave your finances in ruins if you do not know they exist. Understanding the logic behind a policy is the only way to avoid unpleasant surprises when fate puts us to the test. Let's talk about trap number 1. Normal wear and tear versus accidental damage. This is the master clause in home and auto insurance worldwide. Insurers cover sudden and unforeseen events, but they systematically reject any damage that they consider could have been avoided over time. Imagine the situation of a homeowner who, after heavy rain, discovers that water is leaking through the living room ceiling, damaging a $2,000 television and an expensive rug. The adjuster arrives, climbs onto the roof, and takes photos of slightly shifted shingles or a dried-out silicone seal. In his report, he will not write that the rain caused the damage, but that the lack of preventive sealing allowed the leak. For the insurance company, the water is just a symptom. But the disease is your neglect, and by contract, they do not insure your lack of memory to perform repairs. This leaves many families in Latin America and the United States helpless after storms that, while strong, do not qualify as extreme catastrophes, according to the fine print. I remember the story of a man in Florida who watched as his roof collapsed after a severe storm. He was calm because his insurance was up to date. However, the company adjuster determined that the roof was already 15 years old and the shingles were porous from the sun. The company's conclusion was that the storm only finished breaking something that was already damaged by the weather over the years. They denied the $20,000 payment, and the man had to take out a high-interest loan so he would unlose his home. This distinction between what is an accident and what is lack of maintenance is a very thin line that companies use mainly to shut off the flow of money. Understanding this is the first step toward not living in a false sense of security. When we review our policies, we must look at how they define a claim, because often the wording is so ambiguous that almost anything that happens in a house more than 10 years old can be classified as normal wear and tear. Moving on to the second trap, lack of occupancy or abandonment of the property. Many people who travel between Europe and Latin America, or who have vacation homes in the United States, do not know that a large part of policies have a clause that invalidates coverage if the house is uninhabited for more than 30 consecutive days. Imagine that you close your house to spend a season with your children in another country, and while you are away, a short circuit occurs, or a group of vandals enters and destroys the interior. The insurer could refuse to pay by claiming that if there had been someone in the house, the damage would have been minor or detected sooner to them. An empty house is a much higher risk that they are not willing to assume without charging an additional premium that almost no one knows about. This clause exists because without human supervision, a small leak becomes a structural collapse in a matter of weeks. Real situations happen constantly with expats or retirees. Imagine someone who has a property on the coast of Spain but lives mainly in Mexico. After a harsh winter, they return and find that humidity has rotted the furniture and there was a small flood from a window that was unclosed properly. When filing a claim, the company requests utility bills from recent months. Seeing that consumption was almost zero, they confirmed that the property was vacant longer than allowed at that moment. The policy becomes a useless piece of paper. I knew of a retired couple who traveled through Europe for 2 months. Upon returning, they found that a faucet had been left dripping on the second floor, and the water had destroyed the ceilings and furniture on the ground floor. The loss amounted to $15,000. The insurer reviewed the electricity and water consumption records from the utility company and determined that the house was a loan for 60 days. They applied the occupancy clause and denied the total payment. This is a reminder that insurance contracts are contracts of presence and constant care, not just monthly payment. The fine print is implacable and does not understand sentimental reasons or family vacations, especially when the economic loss is so high that it affects your retirement savings. The third trap is one of the most painful in life and health insurance: undisclosed pre-existing conditions or aggravation of risk. In the United States and Europe, health systems are very strict about this. But in Latin America, the situation is even more complex. Many people omit mentioning a small back pain or a minor treatment from 5 years ago, thinking it is not important. But when a $50,000 major surgery arises, the insurer investigates your medical history for the last 10 years. If they find a single consultation that was not declared, and that has even a minimal relationship to the current problem, they will cancel the policy and deny the payment, even if you have paid very high premiums for years. Insurers have access to shared databases and pharmacies that reveal much more than we declare on the initial form. Consider the anecdote of a woman who took out a $500,000 life insurance policy to protect her children. She smoked occasionally at social events, but checked the non-smoker box so the premium would be cheaper in her monthly budget. Years later, she passed away from cardiovascular disease. The company requested an autopsy and reviewed her old medical records, where they found a note from a dentist mentioning nicotine stains on her gums from a decade ago. They determined that there was misrepresentation in the initial declaration and denied the compensation to her children. The savings of a few dollars a month ended up costing her family a lifetime of well-being. Honesty in these contracts is not a moral issue. It is a matter of financial survival in 2026, because a technical error or omission is the perfect excuse for the capital never to be delivered to the beneficiaries, especially when the sums involved are in the millions. In the world of insurance, what you keep quiet today is what they will use against you tomorrow. The fourth trap involves geographic location and specific risks not covered, such as floods or earth movement. Many people assume that their home insurance covers everything that happens to the structure, but the educational reality is that events like earthquakes or external floods usually require a separate policy or a special endorsement in cities with complicated topography or near rivers. A landslide can destroy a $200,000 property in seconds, and the owner will discover with horror that their standard policy only covered fire and theft. These exclusions are based on risk maps that the insurers know perfectly but that the user rarely consults. Imagine living on a beautiful hill with a view of the valley somewhere in Colombia or California. After an intense rainy season, the ground gives way slightly and structural cracks appear that compromise the family's safety. When calling the insurance, the technician explains calmly that the landslide is an excluded geological risk, unless the earthquake or extended seismic risk clause was purchased. I remember a family in a coastal area who suffered a flood from an exceptionally high tide after a storm. Water entered the living room and damaged valuable furniture and appliances. They thought their water damage insurance would protect them, but the fine print specified that they covered internal pipe bursts, not water coming from the outside of the property or from the sub. The $30,000 loss was total because they had not read that the risk of external flooding was expressly excluded. This happens mainly because we trust what the sales agent tells us verbally to close the sale and not what the printed contract legally establishes. When the disaster is natural and massive, companies usually apply geographic exclusion clauses with surgical precision to avoid massive payouts. Finally, the fifth trap is that of limited value objects and coverage sublimits. If you have expensive watches, jewelry, or technological equipment worth thousands of dollars, your home insurance probably only covers them up to a limit of $500 or $1,000 unless you declare them separately and pay extra. Many people feel safe thinking their house is protected for $300,000. But if a camera collection or a $10,000 family heirloom is stolen, the insurer will only give them a tiny fraction of the actual value, arguing that those objects should have had a special coverage called a scheduled personal property endorsement. Real situation. A graphic design professional in Madrid has his home office with high-end computers, specialized monitors, and drawing tablets. Everything adds up to a value of $12,000. One night, they break in and steal everything. He calls the insurance feeling backed by a $60,000 global content policy. However, when reading the breakdown of the compensation, he sees that there's a sublimit of $1,500 for professional use electronic equipment. The rest of the loss, $10,500, must be borne by him. There was a well-known case of a professional photographer who had all his equipment in his house. A robbery occurred, and they took cameras and lenses worth $15,000. He presented his home policy with great coverage, but he found that the category of electronic equipment had a cap of $2,000 per event. He lost $13,000 of his professional tools because he had not made a declaration of special goods. This is a situation that mainly affects independent professionals and collectors who assume that global coverage protects every detail, when in reality sublimit exclusions are the norm in the industry today. Do not assume that by insuring the structure of the building, the high-value content is automatically protected, because the fine print usually treats a diamond jewel the same way as a used television if there is no prior appraisal. We reach the end of this analysis with a clear conclusion. Insurance is a useful tool for mitigating risks, but only if it is understood as a technical contract and not as a promise of goodwill or a friendly relationship with the agent. At 40 years old, we have already learned that no one takes care of our money better than we do, and that the responsibility to read what we sign is non-transferable. Education on these topics is what separates those who maintain their wealth through crises from those who lose it to an unexpected event. It is about reading, asking until you are exhausted, and never assuming you are covered just because you are paying those dollars every month that cost us so much to earn in this very competitive market. It is vital to understand that the adjustment process is the moment where the insurer sends an expert whose job is to find reasons not to pay. If we know these 5 traps, we can anticipate them and keep our documentation in order. Photos of assets, maintenance invoices for the roof and pipes, and precise health affidavits. Prevention is not just paying the premium, it is building the file that forces the company to fulfill its part of the contract when the claim arises, especially when the stability of our home is at stake. To close on a high note, I want to leave you with advice from one of the richest men in history, J. Paul Getty, who in his time was the wealthiest man in the world. He used to say that to be successful, you must know your business better than anyone, and pay attention to every detail, even the ones that seem insignificant. Getty applied this to his oil contracts and his insurance. He never signed anything that had not been reviewed down to the last comma, because he knew that in that last comma is where financial losses are hidden. Follow this mentality of precision in your personal finances. Be the owners of your information and do not allow the fine print to decide your family's financial future or destroy decades of effort. Thank you for joining me today on this educational journey. Keep protecting your wealth, and I will see you in the next installment.